Good afternoon, this is Sean Golden with Golden Golden, here to discuss the basics of the tax treatment in the United States of a UK SIPP, a self-invested personal pension plan. This is something that we see often. It's very common for people who reside in the UK to have SIPPs, especially if they were self-employed or just wanted some additional retirement padding similar to an IRA in the United States. Now, we're only focusing on the UK SIPP, not like the QROBs in Malta or things like that. Since the United States and the UK have entered into a tax treaty, it can get a little bit confusing regarding the taxation, possible reporting of the SIPP. Now, whether or not the SIPP was created from the get-go or whether you have multiple pensions that were kind of combined into one SIPP can impact how it's treated in the US and possibly how it's taxed. And when you're dealing with SIPPs in the US, there's two issues. There's the taxation and then there's reporting. So why don't we go through the basics? Even though a SIPP is kind of treated similar to an IRA or a 401k, it's not the same thing, okay? From a US tax perspective, you don't get all the benefits, all the bells and whistles you would get if you were contributing that money into the US version alternative. So one thing to keep in mind is what type of assets are underlying the SIPP. For example, let's say you had a SIPP and everything, all the assets within it are Vanguard ETFs. Well, then that's going to impact the reporting and the tax versus if you said everything in your SIPP are foreign stocks and securities, or are they foreign mutual funds, ETFs, and CCOF. So kind of getting an idea of what the underlying assets are within the SIPP will impact the taxation rules. In general, if you have foreign mutual funds in the SIPP, then you don't necessarily pay tax as you go because they're foreign mutual funds, and then you may have a Form 8621 complication, and then down the line when you start taking distributions, they may be considered excess distributions. So that's something to keep in mind as well. If you're receiving distributions from it, typically it's going to be taxable, right, because you're receiving distributions. But if you have income being generated and accrued within the SIPP, then that's something that you got to discuss with your specialist to kind of go through what the different assets are, what type of income are they generating, are the assets within the SIPP US-based or foreign-based, et cetera, et cetera. Reporting for the SIPP is typical of reporting any type of foreign pension plan, right? You've got the FBAR, Foreign Bank and Financial Account Reporting. Technically, the form is referred to as FinCEN Form 114. FinCEN refers to the Foreign Financial Crimes Enforcement Network, But don't think about the word crime. I always mention this because it's always this fear-mongering thing online. Most of the time, nearly all of the time, FBAR non-compliance is not going to be criminal unless there's other aspects like structuring, money laundering, tax evasion, things of that nature. The FBAR is typically filed in any year that a taxpayer has more than $10,000 in annual aggregate total in foreign accounts, not per account, it's an aggregate total. FATCA, Form 8938, is another common reporting requirement. FATCA is similar to the FBAR, but it includes more reporting in that you also have to identify income associated with the different assets identified on the Form 8938. The Form 8938 is part of the tax return. The FBAR is filed separately. We have a whole nother presentation just going through the basics of FBAR. We're comparing FBAR versus 8938. You may have to include items on both of these forms. Now with the 8938, it can get even more complicated when you have things like foreign mutual funds, because you may also have a Form 8621 requirement, which is used to report PFICs, like passive foreign investment companies, including foreign mutual funds. But typically you don't have to duplicate the reporting, but if not all of your assets in the SIPP are foreign mutual funds, then there can be some, it's just duplicative in nature. So again, something to go through with whoever you're working with. There's also the Form 3520 and 3520-A. Now that is used to report gifts and foreign trusts. But in 2020, the Form 3520 is complicated and much more complicated than the FBAR and the 8938. And even the IRS recognized the complexity of the form, especially in things like tax-deferred retirement and non-retirement fund schemes. And so they developed Revenue Procedure 2020-17, which doesn't specifically say you don't have to include SIPPs, but it basically says if you have tax-deferred investments and retirement investments in foreign countries, you meet the requirements, which are, of course, are ambiguous in nature, then you can avoid the duplicative nature of having to file 3520, 3520A, even though you would still do FBAR and FATCA. If you're out of compliance, there's various programs you can use to get into compliance. If you're willful or just can't certify under penalty of perjury that you're non-willful, you would do voluntary disclosure, VDP. Otherwise, if you're non-willful, many other programs available to you. Streamlined filing compliance procedures, domestic and foreign, which is just based on the residence of the person. They both refer to foreign assets or offshore assets. When the IRS uses offshore, don't think of it as like some seedy thing in some tax exempt country. It just means money outside of the United States. Other than if you're non-willful, there are alternatives to streamline. There's something called reasonable cause and something called delinquency, although the latter program was modified at the end of November 2020. We have lots of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.